Well, hello, everybody. We're just so grateful also that you could be with us today. I was just thrilled when I saw the list of folks that were with us. And so I know the caliber of the people that are listening, and I could easily be the person sitting down and you could be the person standing up here presenting. So that's terrific. But speaking of, the person I get to co-present this with is somebody that I've been a raving fan of for many, many years now. Cheryl is, and one of the cute things I love about Cheryl, in addition to, we all get in our little boxes, right? Maybe you didn't know, but that Cheryl was actually a world famous bullfighter. And so that's really where she began. And then she was able to morph over from that. And I'm absolutely lying through my teeth, so I apologize for that. No, she was actually an electrical engineer, got her degree from Cornell. So you can just see that, though, that nice, steady, predictable, okay, A to B to C to D. Me, yeah, not so much. But that's why I love having people around me that are predictable and they're super smart. I have thrown so many business cases at Cheryl over the years. What did we do? Cheryl, we did an avocado rancher. We've done one of the top interior designers in the country. Gosh, we've done one of the top digital marketing and advertising firms. And I just can't seem to give you a case that you can't handle. So you've been in the valuation of businesses for over 25 years. And so you're a delight to work with. So Cheryl and her firm are, of course, local, but they have really the muscle of CBIZ, which is a national powerhouse. So anyway, Cheryl, as always, I'm honored to be co-presenting with you. And as far as my background goes, first of all, I want to remind everybody that this is not what we do for a living. So standing in front of a screen, presenting and things, making sure that, that's not what we get paid for. So please be kind in your evaluations for us. We're here to just try and share the best we can. So for me, I've been in practice now over 35 years. I started up in the Pacific Northwest, started in the life insurance industry and morphed over time to be involved in a total practice. We have 6 different brands in the Wealth Legacy family of companies. The biggest reason why I do what I do is my father died when I was 18, and he had built a multi-million-dollar company. And tragically, I watched that company go into bankruptcy within 10 years after his death. More to me, rather than the loss of wealth, I mean, some people say, well, yeah, you guys lost a lot of money. That must have affected you. And honestly, that's not it. We were fortunate. My parents had done some quite amazing asset protection planning, especially for the little town in Central Washington that I'm from. And it was way out in front of what we consider today as asset protection planning. But what was more affecting to me was the fact we had employees, some of them had been with us for over 30 years, who lost their jobs. And I mean, honestly, working for Keller Oil Company was the only business they'd ever worked for. So that really affected me. And so I said, when I got out of college, rather than going to marriage and family therapist, becoming a marriage and family therapist, as I thought I was going to do, I instead decided I would go into a business where I could help make a difference in the lives of others in the business world, especially. So our clients are basically privately held pre-liquidity business owners, as well as a lot of professionals and executives, as well as increasingly a number of situations where someone's having a liquidity event. They're selling a business, they're selling an appreciated asset, and they want some alternatives about how to not pay tax on the sale. So we're doing a lot of that consulting as well. But anyway, we're just delighted to have you with us. So let me kick this off. Let me let you know, as the saying goes, we're going to tell you what we're going to tell you. We're going to tell you, and then we're going to tell you what we told you. So let's start off with what is our agenda for today. And the first one is, what makes a good buy-sell agreement? Why is that important? And what are some of the triggering events that will cause that to be needed or come into action? What are some of the considerations that go behind the scenes? How do we value a company? And of course, that's going to be Cheryl, and some of the different options for getting that number on the page. And why can it be there's such disparate values? We're going to talk about the different methodologies and really what we would recommend that you use. Again, for us professionally, all of us that are on this call, for the most part, for most people on this call, this is a growing area of litigation against us. And so, yes, I'm a certified exit planning advisor and a chartered financial consultant and a bunch of other things. So I'm more at risk, but I'm here to tell you, you probably are too. So it's we need to find out where some of the mistakes that get made and some of those areas of litigation that are popping up. How about stress testing the buy-sell agreement, making sure that it really works before we need it? Gee, what a concept. What should you look for when you're out there and you're trying to advise your clients, or maybe you're a business owner who's logged in today? What are some of the credentials that you need to really be aware of and be looking for? And then how do you fund it? I mean, you can have what called a naked buy-sell agreement, where all you've done then is you've put things down in writing about what happens, but unless you've got some funding there, you've just created a liability. You haven't done anything to really make this thing go away. And then on top of that, just because you get a good buy-sell agreement, there's some other stuff as a business owner you need to have put to bed as well. So can we get started? That'd be okay? We're gonna do a poll first. Make sure you're paying attention. I haven't put you to sleep yet. Right. I was trying to get a polling question that just said, how many of you are wearing shorts and sandals that are listening to this video? And I think it would have probably been 90% or more. Okay. So first thing, does your client have a buy-sell agreement? And what's your process for asking if they do? As I said a moment ago, this is a growing area of liability for us as professional advisors. If we don't have a process by which we're asking for the buy-sell agreement, or if they have one, we might be in trouble down the road. Of course, for that business owner, when was the last time it got reviewed? One thing to have it, another thing if you just put it on the shelf and never dust it off and never look at it. Has the situation changed? Guess what? People go through divorces, people's kids die, people keep people leave, partners have heart attacks. So this thing needs to be part of an annual review process. At least that's what we do in our practice, is to review these documents and have conversation to make sure that things are current and we understand what may have changed, and are there things missing from the agreement therefore. And of course, what's really important as well is who is going to value the shares, or when was the last time that you valued the shares. We got a request from our last meeting, someone wants to meet with us. And so my question back to him was, has the business been valued? And if so, how recently, by whom, what were their credentials, so forth. Another thing, every business needs a buy-sell agreement, even if it's solo man uno, even if it's just you need to have a buy-sell agreement. You might say, well, how do I do that? How do I have, there's just me, how do I have a buy-sell agreement? Well, I'm not here to tell you that it happens all the time, but I can tell you that it happens rather frequently, that we can find a friendly competitor, might be a good friend in the same industry, where you guys agree, hey, you die, I'll buy. Or you become disabled, or you want to retire, come and see me first, give me a right of first refusal. It could be there's a consolidator out there in the business where they are looking at doing some roll-ups. So it is possible, and it really should be explored, that you've got that nailed down. Don't let this go to the spouse because they are going to be in a weak position for negotiation. You need to be there to negotiate it while you're healthy, alive, you got money coming in the door. That's when you need to be sitting down talking about agreements. And then obviously it's important that you define what the triggering events are. They're going to activate the buy-sell agreement. We're going to look at some of those in a minute, but one of them that's very important is it going to be a mandatory buyout, or is it optional? Do you have to sell, or does your family have to sell? And one of the other things is, okay, maybe you have a cross-purchase agreement or an entity where it's the business that buys back the stock, or a cross-purchase agreement where, of course, it's your partner or partners. But then you can put a provision in that says, well, if the partner chooses not to buy, if it actually makes more sense at the time that the business buy, great, we'll let them do that. That's what's called a wait and see buy-sell agreement. But you have to have language in there that allows for that. And we'll talk about a Hewlett-Packard buy-sell agreement more in a minute as well. What's the evaluation process? What's the methodology that's going to be used to determine what the price is going to be? And is it different for when you die, for when you become disabled, when you want to retire? So you've got to address the issues of how is that business going to be valued, and when is that business going to be valued, and to determine what the purchase price is going to be. So for example, there's a whole lot of subchapter S corporations out there and they may have some key person life insurance, they may have some life insurance for the buy-sell agreement, but you better value that S corporation the day before anybody dies, because otherwise you'll be ballooning up the value of that business and maybe increasing the purchase price if you don't have a specific date by which that business is valued before all that life insurance comes in. Now, you might say, RJ, give me an example. Well, where would this be? Where would this fit? Why should somebody have a buy-sell agreement? Sell me on this idea. Okay, well, let's talk about this one. Parents own a lot of real estate, and in this particular case, they set up an LLC to own this one very large apartment building, and they had other stuff, but this one was by far the mothership of this family. So they obtained a valuation, and they got what we would call lack of marketability and a minority interest discount, and so those can be sometimes 30%, 40%, sometimes even higher. And so that discounted value, they were able to give it to the 3 kids. Now, mind you, only one of the kids was involved in the business, and he ran the day-to-day. The other 2, absent, they were doing their own thing, but they had each a 1/3 ownership. Now, after the second parent died, usually this doesn't happen while both or one of the parents are alive. Those are what we call the guardrails on the emotional strings of that family. But inevitably, when that second spouse dies, the guardrails are off and all breaks loose. And so in this case, the son, who was the manager, said, look, I'm doing all the work. Why shouldn't I get then all of the benefits from this going forward? So he went to his sibling and said, I want to buy you out. But he proposed the price at the discounted value that was used for gift tax purposes. There was no buy-sell agreement in place. And so things got nasty over time. In fact, litigation ensued, no surprise, and the siblings no longer talk to each other. At least they no longer talk with their brother. So that's a critically important reason why a buy-sell could have not eliminated, but certainly could have made those things be much less likely to occur. What else should there be in a good buy-sell agreement or a proper buy-sell agreement? There should be mechanics for resolving these kinds of disputes. What do you do if people don't get along? And the fact is, we're all whacked. Every one of us is broken. There's some days I'm more whacked than other days, but and we'll talk more about that as well. What can you do to help unstick the stuck? And in fact, in August, I'm going to be doing a webinar on that topic with a couple of very smart people that can tell you how to unstick the stuck. But it's very important, especially as I say, when the guardrails on the bridge fall off because the parents die. Now, you may want to limit from the standpoint of rights of first refusal, so that the surviving partners or shareholders, members, they have to, before they can sell their shares, their ownership interest, they have to come to the surviving partners, members, so forth, before they can go out and start looking for another buyer. That's pretty common, but make sure it's in there. Now, don't see this as often, but what for about minority partners, what about for them? Are you going to give them veto rights? Sometimes we do, where they get the right to say, no, that person would not be an appropriate new owner in this company. You might also, in some very few cases do I see this, but where you might give a minority owner a right to sit on the board of direction of the company. Now, what else could you have there? Well, you might want to address what retirement looks like. Is it a specific age? What happens, is it going to be you're either on the saddle, in the saddle, or out of the saddle, in or out completely, or more often than not, what we're seeing is this sort of gradual retirement. But whatever it's going to be, make sure that that's being addressed in the buy-sell agreement and thought through and talked through ahead of time. What about in terms of sitting down and really having Cheryl come in, get a valuation for the company, and then sitting down and having a very frank conversation about, you know what, I know you'd really love to have Joe Schmo and Jane Main buy the company. They've been with us a long time, but where are they going to get the money? They don't have it. So unless you're willing to fund them or become the bank, it may not be practical, in fact, to sell that business. And so you may need to look for an outside buyer. You may need to have employees buy it through an ESOP. It may be, maybe do an IPO, initial public offering, maybe go public, God forbid. But anyway, having a conversation about the liquidity needs because of the buy-sell agreement is oftentimes something that's a big eye opener for people can say, you know what we wanted to do is just not realistic. The other thing is that with having a buy-sell agreement, you don't build it, put it away and forget about it. No, what by having those something in writing, there are people probably, you may be one of them. I am certainly one. I'm a perfectionist. And sometimes I don't get things done because I want it to be right, perfect the first time. That's just not realistic. So therefore, having a business document, putting in place that you can reference, guess what? You can polish it over time and make it better. But it's more important to get it, to have something there to work with. And of course, having a buy-sell agreement establishes the market for the business owner in the event of these kinds of things. Death is one of the major triggering events, but disability is another one. What happens if the paramedics get there too quick and they keep your heart still going, but you can't talk in completed sentences anymore? What about if there's a divorce, God forbid? Do you want to be in business with your partner's ex-spouse and her new husband who happens to be a litigation attorney? Maybe not. So again, another important reason for having that in the buy-sell agreement, and the spouses have to sign off on that while everybody's getting along. What happens if you disagree, have disagreements between you and your business partners? Does that happen? Like only all the time. And then what about a deadlock? If you have a business where, because you think, gosh, we're both coming at this equally, we're 50-50. Okay, well then what are you gonna do when you disagree and you have a big loggerheads? How do you resolve that? You better have that addressed in a buy-sell agreement and some other documents too. What happens if you get fired or their partner gets fired? Or what happens if there's, again, long-term permanent illness that affects the ability to come and work? How about, again, looking forward to retirement? What if somebody wants out early? They thought they were gonna retire at 65 or 70, and now they want out at 52. You better address that in the buy-sell agreement. What happens if one of your partners decides to leave and go work for the government or go to work for China or who knows what? But you better have provisions in there if they go to work for a competitor. What happens if they lose their license? I don't mean just on the sidewalk. I mean, what happens if they get into litigation and get sued? And this is not comprehensive, but this hopefully is getting your juices flowing to recognize that, oh yeah, there's a whole bunch of things that our buy-sell agreement needs to have. I better review that. Again, you need to decide, is this going to be optional or mandatory? And so what happens too if a partner guarantees a loan, or the two partners or three or whatever guarantee the loan personally, and the business defaults on the note? And now one of the partners has retired. Are they absolved from their responsibility? So again, you need to address those things in advance. Now, a moment ago, I talked about the Hewlett-Packard buy-sell. And my point on that is there are sometimes companies are built and they've become so successful that to have a buy-sell agreement buy out a family is really a disservice to the family. Example, what happened if Bill Hewlett had died, and so Dave Packard's family bought them out for $3 billion or whatever the number was. And that would have been grossly unfair to the Hewlett family. But on the other hand, Packard would not want to have his that family, as much as you might have loved them, voting the shares of stock, because they're typically at loggerheads. Those that are still in the business have a different vision about where that business should go versus those that are looking for income. So what you might do then in that case is make sure that the shares then get voted by the surviving partners. But the family better make sure that there's plenty of life insurance for all the family members so that they don't have to push for the sale of the stock. In fact, they've got millions of dollars of insurance that can generate income while they're waiting for a future liquidity event. And here's a really big one. Cheryl and I have a friend that got stuck in, she was the majority minority partner in a company, and they just took the business a different direction, and they kept money in the company, but they tried to force her out by obviously declaring income, but not taking distributions. So here, our friend was paying taxes on income that was stuck inside the business. So you need to put something probably in that buy-sell agreement that requires a mandatory distribution of at least enough money to pay taxes on earnings that don't get distributed. Now, we've seen that one happen a bunch of times. Okay, time for another poll question. And I choose vanilla. That's generally the first answer that I go for. considering CBiz is back in Kansas City, I might also choose Hallmark cards as being the second option, but okay. And now I'm going to turn this over to Cheryl, who's going to start talking about standard values. So Cheryl, take it away.
All right, thank you, RJ. Yes, so any buy-sell agreement, when you talk about the valuation language, what you normally see is fair market value in the buy-sell agreement. So if I'm to value the company, the buy-sell agreement says that the appraiser determines the fair market value of the company. But what that means to me is if we're valuing a less than 50% interest in the company, then I would apply minority and marketability discounts. And as RJ mentioned, you know, those discounts could be substantial, anywhere from 25 to 45%. And so it's really important that the buy-sell agreement specify either value the company on a controlling basis or specify its fair market value, but we're not applying discounts. Or, you know, in some cases, maybe you want to apply discounts. The next standard of value is fair value, and that's used for financial reporting purposes. Usually there's marketability discounts and no minority discounts. And then there's another statutory fair value for legal cases for dissenting shareholder rights. And in those cases, the legal definition is that no discounts will be applied. And then the final standard of value is investment value, and that's the value of the company or the interest to a particular owner, and that takes into account strategic value or any specific value to the person retaining the business interest, and it happens to be the standard of value that we use in a divorce setting. So here's the level of value chart, and you see, you know, at the top is strategic value, and that's the highest price that you could get. So if you put the company on the market and you get multiple bids, and you know, a buyer comes in and you know, they can push your product, you know, worldwide. That's what we're talking about as in terms of strategic value. And control value is what a financial buyer would look at when they value 100% of a company. And that's fair market value for a controlling interest would be the control value. And then marketable minority is after you take minority discounts, and think publicly traded stock. It's marketable, you can get your money in 3 days, but you still are a minority shareholder. And then of course the lowest value is non-marketable minority, and that's a minority interest in a privately held business. So in that case, you have minority and marketability discounts when valuing those shares. So there's a lot of different methodologies that I've seen and that you may see in buy-sell agreements that specify, you know, how to value the shares. And one of them is formula agreements. So for instance, let's say you see a buy-sell agreement that says, we're going to value the shares based on 4 times EBITDA. And well, you know, it's certainly very easy to apply. You don't have to hire me to do it. But the question is, what EBITDA? You know, is it last year? Is it the average of last 3 years? And let's say that you do, oh, we're going to average the last 3 years. That sounds reasonable. Well, what if the company all of a sudden is exploding in growth? Then you're going to drastically undervalue the company. And what if the last 3 years you were in a strong economy, the company was doing great, and a recession hits? Now you're going to value the shares based on the last 3 years, ignoring the fact that the economy's now in a recession and the company's tanking. You know, so you can see how that could be a serious problem. And then there's what's sometimes called Russian roulette or Dutch auction provisions, and it's usually for a 50-50 shareholder. But it basically says, let's say I want to sell my shares. I offer my shares at a specific price, and then the other party can say, okay, well, I don't want to buy them. I'll sell mine to you at that same price. So that's how that works. And it really only works well with 50-50 partners, and some people say that it really doesn't work well at all. So use your discretion. The other thing I do see a lot is annual valuation by the principals and the shareholders. And basically, it's just like every year we're going to figure out, what the value is of the company is, and we're going to write it down and both sign it. Well, the problem is business owners don't really know what their company is worth. It's not publicly traded on the stock market. If they've never had a valuation done and they're not valuation experts, how do they know what it's worth? And not only that, they don't have access to the databases that I have in terms of, sales of other businesses in the industry. So they're not going to be able to do an in-depth analysis. And then sometimes you see book value, and this is typically the lowest value in a valuation. So if you really want to make the value low, you specify in your buy-sell agreement that the partner is going to be bought out at book value. And so that's essentially the assets less liabilities on the balance sheet, using accrual accounting methods. It does not take into account goodwill or intangible value based on the cash flow generation of the company. So another method I see sometimes is you have both the buyer and seller each select an appraiser, and then those two appraisers select a third appraiser to value the company, and they provide the sole appraisal. Well, that sounds good, and it means that there's only one valuation, but the reality is appraisers disagree, and sometimes really materially. And so now you've hired this one appraiser, and that's the only shot you get to determine the value of the company. And what if you don't agree with that valuation? So there's another method where you hire 3 appraisers, and the third appraiser does not prepare an appraisal, but reviews the other 2 appraisals and decides what's the most appropriate, and essentially acting like a judge. At least in that case, you've only paid for 2 full valuations and not 3. So that's good. There is some reason for maybe doing it this way, but there's also the whole issue of discounts as well. And we'll talk about that in a minute. So I see this one probably more than any other is where 3 appraisers are hired and the 2 closest are averaged in some way. But, the real issue is if you're averaging, let's say 2 appraisers, made one assumption, and let's say the assumption is minority and marketability discounts apply, and then the other appraiser said, no, they don't apply, then you're valuing the 2 lowest values. There's also potential disagreements on how you handle taxes in the income approach called tax affecting. What if one appraiser applies no taxes to the income stream and the other 2 appraisers do? You're going to have really big differences in value. And not to mention, hiring 3 valuation people to appraise a business is really expensive. And then you have to provide documents to all of them. And, it's a really lengthy and time-consuming process. So what I would say is that it's really important to have a business appraiser review your buy-sell language. Don't assume that the attorney knows anything about valuation. Some certainly do, but I think it's still a good idea to have a business appraiser actually review it, and select at least one independent valuation firm and have that firm value the company today. So, and what's really good about that is then the business owners have some idea of what the company is worth. So let's say the business owner has a valuation done every 2 or 3 years, and in between they determine the valuation in between. Well, at least then the business owners have a realistic expectation of what the value is worth, and so there's no surprises when it comes to a trigger event and somebody has to get bought out. And also, when you're doing a current valuation where there's no trigger event, you know, both the buyer and potential seller and all the partners actually have some say into the process. They get knowledgeable on the process, and so you're less likely to have litigation later. So one thing that I don't ever see, and that is what tax rate should you apply in the income approach in valuing a pass-through entity? And so this is a big deal because there's big swings in value based on your assumptions of how you apply taxes. And when I say pass-through entity, I'm speaking with S corps, LLCs, and partnerships. And the difference there is taxes are not paid at the corporate level. The shareholders get a K-1 and they pay taxes on the business income via their personal tax returns. So the other thing to define in a buy-sell agreement is the valuation credentials. I don't really ever see anybody talking about what credentials the business appraiser should have. Sometimes I see it when it's real estate, you know, and they say, you know, hire a MAI, but I don't ever see anybody saying what credentials the business appraiser should have, or what standard of value should they be following the uniform standards of professional appraisal practice and the ASA business valuation standards. I know I do. And then, you know, what's the funding mechanism? I know RJ is going to talk more about that later. And then for sure, if the buy-sell agreement is mandatory or optional. Let me talk about that for a minute. Let's say you have a situation where a minority shareholder, there's 3 shareholders. One of the shareholders is, well, they're all minority, and one of the shareholders gets fired. And now that shareholder, the other 2, it's only optional for them to buy their shares. So, you know, what happens in that situation? The shareholder that got fired now has no job, and in addition, could end up a minority shareholder in this company with no control, you know, forever. So, you know, it's really important to think about in the different trigger event scenarios if you want those buyouts to be mandatory or optional, you know. And I would think certainly if you have a shareholder leaving and going to a competitor, you want to make it mandatory that that person sells the shares back to the other shareholders or the company. We now have a polling question.
And Cheryl, I remember what company I think that you're referring to there, a mutual friend of both of ours, and that was very, very difficult.
Yes, exactly.
Mm-hmm.
So now I'm going to talk about, I mentioned earlier the idea that, you know, it might be a good idea to specify if the company is an S Corp or LLC, to specify how taxes are going to be taken into account in the income approach to valuation, to provide a guide for whatever business appraiser ends up getting hired to value the company. So I just wanted to give you some examples of the swing in values. And you look at this chart for a non-service business using the different tax assumptions. The value swing is anywhere from 10.9 million to 15.9 million. That's a pretty big swing. And, you know, for services businesses, it's 10 to 14 million. And so what these different methodologies are is the first one is that you say, well, even though it's a S corporation, we're going to apply a C corp tax rate to it. And that's the top line. And then the others are all different types of pass-through entity valuation models that try and take into account the differences between C corporations and S corporations. But because of the big swings, that's why I think it's helpful to specify in the buy-sell agreement what approach is going to be followed for a pass-through entity in applying taxes. There's also some tax considerations. You know, if the company is a C corp and there's built-in gains, maybe there's some real estate in the company, it could be a big potential tax liability to the buyer of the shares. So it needs to specify how that's going to be taken into account. And, you know, also, you know, one thing to think about is, you know, if somebody is buying out another shareholder, you know, there's basis issues, there's tax considerations. So it's important to think about, you know, if somebody is buying the shares of the selling shareholder and tomorrow they turn around and sell the company, what's going to be the tax impact on that buyer? And I think that should be taken into account and considered when setting up a buy-sell agreement or upon a buyout. So there's some common preventable errors in buy-sell agreements. I guess the number one is if you don't have a buy-sell agreement, and I'm going to talk about that. A little story. I've got to tell you, I think that is the biggest problem I see when I get involved in litigated cases. It's most of the time it's because the shareholders never put a buy-sell agreement in place, or if they did, it's defective and doesn't cover all of the potential trigger events. One in particular I'm thinking about is it was a brother and sister. They were each 50-50 owners. Of course, no buy-sell agreement. Brother has a stroke, so sister ends up taking over running the company. And then brother wants back in once he recovered, still had some memory loss issues. Sister didn't want him involved in the company anymore. And they filed a lawsuit against each other. And luckily, the judge ordered that they hire an independent neutral appraiser to value the business in order to reach a settlement. And so I got involved in that capacity and was a neutral expert to help them come up with a purchase price so the sister could buy them out. But really, you know, brother, sister filing lawsuits against each other. If there was a buy-sell agreement in place, it's a lot less likely that that would have happened, especially if they ever got a current value on the company. So, you know, the other thing is, you know, failing to review the buy-sell agreement every few years. There was another one I got involved in. It was a pass-through entity. It was an operating business, and they had real estate in the business inside the same company. And the buy-sell agreement, they specified that the other partner would be bought out based on life insurance proceeds. And the life insurance proceeds were $2 million. And it was a fixed price. And, you know, I don't know about you, but real estate values do change. So it's really unrealistic to have a fixed price in that buy-sell agreement, especially with real estate and an operating business, both in the same company. But, you know, if you have it reviewed every few years, you can find these problems in the buy-sell agreements. And then obviously, you know, a lot of times people get sloppy. Spouses don't actually sign the buy-sell, which is hugely important. And you have new shareholders that join and they don't sign the buy-sell. Their spouses don't sign the buy-sell. And then promissory notes. So many buy-sell agreements specify that if the life insurance isn't enough, the rest would be in the form of a promissory note. So, but there's no form of the promissory note attached. So now all of a sudden there's a trigger event or buyout event, and then they're negotiating what the promissory note should look like. Way easier to take care of that at the outset when the buy-sell agreement is being set up, or after you review it and realize it's not there and then it gets amended. So as I specified before, common area of litigation, there's just no buy-sell agreement at all. The value of the company is not known. Shareholders have massive differences in opinion of what the company is worth. They've never had a valuation. They don't know. And, the whole issue of minority and marketability discounts, I get a buy-sell agreement that says fair market value, and I'm buying out a minority shareholder, I'm going to take valuation discounts. The buy-sell agreement doesn't say anything else. Now, clearly, they can negotiate something other than that, but still, if they're hiring a business appraiser to appraise it based on fair market value, I'm taking those discounts for a minority shareholder. And so not all the triggering events are covered. There was one, the company that we got involved with, the company was doing 60 million a year in sales, and they had a buy-sell agreement, but it only covered what would happen if one of the partner died. No other event, and now they were in disagreement, and there was no provisions in the buy-sell agreement to deal with that. The other is, okay, so you have this great buy-sell agreement and somebody's retiring, but the other shareholder doesn't have the funds to do the buyout. That's a big problem. If that's going to be an issue, you can address that in a promissory note or, some other method. But, how do you even know if it's an issue if you've never had the business appraised? And then the agreement on distributions is also a biggie. If the controlling shareholder doesn't make distributions to cover the tax liability, that's a good way to get rid of a minority shareholder quick, is withhold any distributions and make them pay taxes out of their savings account every year. So I think it's a really good idea to stress test the buy-sell agreement that you may have in place or that your clients might have in place and get a current valuation just to, check the buy-sell for irregularities, to see how the process works, to understand what the value of the company is currently, and maybe in between you can have the principals agree, and then identify who's going to do the valuation work up front if a trigger event happens. That's one less thing to fight about. If you've agreed on a firm, then you don't have to fight about who's going to do the valuation. And then it also manages the shareholders' expectations. If you own stock in a privately held business, you can't go to the NASDAQ and see what the thing is worth. We do that every day with our investment accounts and our retirement accounts. We want to know what it's worth. Well, what if you have absolutely no idea because you're not a valuation expert and you've never had it valued? Could be a problem. Certainly clearing up language in agreement is another good reason to have a current valuation and get some input from the business appraiser. And basically, it's just a good dress rehearsal in case there is a trigger event. You can see what the process is involved and, the time it takes and what things a business appraiser considers. So there's a lot of times I get asked, you know, Cheryl, are you an expert in valuing construction companies? And so what I'd like to explain is there's really two different types of experts in regards to businesses. One is an industry expert and one is a valuation expert. So the industry expert, usually, you know, they know all about the industry, they follow all the trends. Many times they're M&A advisors and they will, you know, list companies in the industry for sale, you know, handle the transactions. But they don't defend work in litigated matters. They don't necessarily have valuation credentials. They don't do it for tax purposes. It's usually just transactional. So a valuation expert like myself, we're not limited to one industry. We value all kinds of industries, all types of businesses, but it's the use of our work which is important. We're not valuing it for a particular industry only for mergers and acquisitions. In fact, sales of businesses is probably only about 10% of what we do. Most of it is tax related, litigation related, divorce related, partner buyouts, that kind of work. So there's different designations that business appraisers get. Many get the CFA credential, which is what I have. It's very common for portfolio managers and people in the wealth advisory industry, and that's what I had. It's not an appraisal credential per se, but you know, certainly is very useful in terms of security analysis and understanding stock valuation techniques. And then the ASA is from the American Society of Appraisers. Requires 5 years of experience. It's really the one that has the most rigorous standards in order to get and the most experience requirements. And then for CPAs, you can get a ABV designation, accredited in business valuation, from the AICPA, and that requires you complete 6 valuations or 150 hours in the valuation work. So, you know, here's just some sample language of what you could put in your buy-sell agreement in regards to credentials. I'm not going to read it. You can read it yourself.
Okay, well.
So there should be another slide here, RJ.
Is there, sorry about that.
No problem.
So that's our last one there.
All right, it's over to you now.
Great. Okay, thank you. So I getting so excited to talk about funding the buyout agreement. I just couldn't wait. So we have a question that's come in. We're going to try to land the plane here fairly quickly too, so we can get a few questions in before we wrap up. So, okay, we've talked about the fact that all these things that are important to put in the document, but the 90% solution, frankly, even while you're in the process, because these documents don't usually get pulled together quickly. And I know, again, some of the attorneys are on this call here, and they are remarkably quick and prompt and responsive, but these things don't happen quickly typically. So what do you do in the meantime? Do you wait till the document gets finished before you apply for some insurance? And my response to that is no, because even if somebody dies or becomes disabled before the document is completed, having plenty of cash usually resolves 90% of any issues, even if a document has not been specified and put into place. So again, that's important. Do start, and also, by the way, if you find out that one of your partners isn't as insurable as you were hoping or thinking, that can create a wrinkle. Now, it's not impossible. There are different techniques that we can use. One of them, of course, is an installment payment with a promissory note. But then again, as Cheryl was mentioning, oftentimes those don't get attached to the buy-sell agreement. It's like, well, okay, they're talking about some kind of note. Where is that? If we do run into issues about insurability, then we have to start funding a sinking fund, getting some cash in place, or maybe we create an employee stock ownership plan. Now, in all my years of practice, and again, over 35 years, I've talked about ESOPs dozens and dozens of times. But as soon as it seems like the business owner finds out what it costs to set that sucker up and then to run it every year, the conversation stops there. And it's like, okay, what else you got? So it does work in some great places, but it just doesn't happen very often. And again, the worst case scenario is there's a situation where there's just going to be a sale of the company, but that is where, again, having a conversation, again, maybe it's going to be with a roll-up or consolidator, a strategic buyer, outside source, that get that conversation started sooner than later. Cheryl talked about the fact that too often that buy-sell agreement doesn't have something to cover disability insurance, or a disability buyout rather, and yet it's 3 to 6 times more likely to happen that one of those partners is going to be disabled and not able to continue as compared with them being killed. And yet it becomes more difficult to work with life insurance. Again, either you're warm and breathing or you're cold and stiff. There's just no middle ground. With a disability, I mean, it goes all over the map. I had a disability situation a number of years ago with a company where one of the partners, they thought he was going to be out for about 3 months from a skiing accident. 3 months turned into 12 months. And when they got to the end of 3 months, it was very apparent that he wouldn't come back anytime soon. And they had really been setting up and their expectations along that line. Now, I'm not suggesting that at the end of normally you would not trigger a buyout any sooner than, say, a 12-month wait. But there are some companies where you just can't go that long. So I've seen a few that have gone with a 6-month waiting period, and then that triggers a buyout for disability or begins a process of paying so much per month. But usually those agreements then allow for the disabled partner to be able to buy back in again. So if they're able to recover and they're back at it, terrific. Then the provision needs to be able to address what happens if you have a disabled partner and then they're able to come back to work full time. So the other thing about having the disability insurance, using that in place, that helps to define whether this is really a disability that would trigger the buyout, as opposed to making it a conjecture on the part of the surviving partners or the non-disabled partners. Now, obviously, there can be disparities of age that impact the premium cost. So that's where sometimes we'll want to use a cross-purchase buy-sell agreement between 2 partners or maybe 3 partners. But because one might be older, 2 younger, there might be differences in premium. And so the younger partners are having to pay a whole lot more in premium on the older partner. There can be disparities that are made up through maybe a bonus situation from the company, and there are different ways we can address it. Or we use what's called a trustee cross-purchase basis, where we let the business provide the funding, but we have an independent trustee that in the death of one of the partners, the funds go to the trustee uses that money to then buy out that partner. And what it does is it gives a step up in basis. I know I'm throwing a lot of stuff out here, but you get a step up in basis for that deceased partner. So therefore it's not, there's not a capital gain event because now we have a step up in basis, even though the business is providing the funds. Yeah, don't try that one at home, but we can talk about it and I can show you pictures. And then what do you do if you set up the buy-sell agreement? Like we had a company, Cheryl and I, a client of ours recently that was valued a few years ago at 5 million. Now they're over 10 million and they're just growing like crazy. So how do you ensure a buy-sell agreement when the business is going rapidly? And what you might be able to do is, I'll talk about that in a minute, but one of the other challenges when you've got a startup company is that you might be able to get life insurance. Again, we have to prove that financially there's a reason for this, and so that you can't just buy as much life or disability insurance as you want. But particularly with disability insurance, you're not going to be able to get the full funding, especially in the early years of that business. So you're going to have to either A, establish a sinking fund, have a promissory note, or something else to address the shortfall that is inevitably going to be there. We find that we're able to go to Lloyd's of London. But we've got another poll question, and we're getting ready to wrap it up here. So please get those responses in. Otherwise, we're going to have Heather come out and put dead fish in your hubcaps. You don't want to do that. Heather's a lovely person, but you don't want to get her mad. So make sure you get your CPE yes on want it. Even if you don't need it, just say yes. Otherwise, we have Cheryl's cousin Guido come over and pay a visit tonight. Now, here's the reality. Entrepreneurs, they hate talking about this stuff. Most of us would rather not talk about the fact that, yeah, we're not getting out of this place alive. There's the old joke that some people die and some people get older, but then there's you and me. Nope, it's to us too. So we've got to be asking these questions about what's the plan for the exit? God forbid you get hit by a Mack truck tomorrow. What's the exit plan look like? And every business owner alive is not going to be at some point. So in Vistage, which I'm a huge raving fan of Vistage and have the privilege of getting to speak for a number of their groups, it's very common for their chairs to, as soon as somebody joins the group, for that chair to sit them down on their very first private meeting and say, what's your exit plan for the company? Now, candidly, most of the chairs tell me that most people don't have a plan. But that needs to be something that you're thinking through ahead of time already. What is the exit plan going to be for the business? Now, as we wrap this thing up here, just because you get a wonderful, beautiful, exciting buy-sell agreement in place, Yahoo, let's pop the champagne corks. There's more stuff to be done. And frankly, if you only have a good buy-sell agreement, but you have no living trust in place, you have no wills, you have no powers of attorney for healthcare or financial powers, and if you've got a big business, maybe you should be talking about having dynastic provisions. My friend Brad can get you, in terms of your estate plan, so that these assets will go on generationally. But the point of the story here is you got to have more planning in place. One of the newest things I've been recommending now for more and more clients, I really like it, is what's called a fast trust. It's not designed to provide any kind of economic benefit to the family, no income, no nothing, but what it's designed to do is to help future generations of family members continue to grow as people, to learn, to be able to have the virtues and the value system that help create the wealth in the first place, to have that continue on generationally. So even when the founders, the progenitors, the people that made the wealth, after they're long gone, what does it mean to be a member of this family? What does this family stand for? Because we know from the research that's been done in it, phenomenal research by the Williams Group, among others, is that what keeps families together generationally is to have a shared value system, a shared purpose, something that that draws the family together more than just money, because most family members, that's not good enough. Okay, buy-sell agreement, yep, got to have it, but you got to have more than that. You also need to make sure that you've got plenty of long-term care coverage in place, because I've seen some great buy-sell agreements, because there wasn't long-term care insurance in there to pick up the cost, and it was $10,000 to $12,000 a month. The family quickly ran out of money, and so the buy-sell agreement basically, so what? It will blow up a long-term care claim can blow up a beautifully planned business exit. And remember this as well. It is a 3 to 5 year process in most cases to plan an exit in your succession. Why? Because it usually doesn't work the first couple times. That wonderful junior partner, that wonderful key operative you brought in, general manager, they get stolen, they get hired away. So understand that it is very important then to try and find ways to tie in that talent. We can create what we call stay bonus plans. We might even want to consider what I call synthetic equity, something called stock appreciation rights plan or phantom stock plans. It's not actual ownership of stock, but it's things to keep that key employee, keep them happy, keep them there on the farm and not get stolen away. In the buy-sell agreement, as well as some of the other agreements, we can address who's going to be there to assume management responsibilities when people step away, either because of death, disability, the 5 Ds we looked at earlier. Decide in advance how that business is going to continue, and then here's some other things. If you're trying to or expecting to find a replacement partner, business associate, understand they're usually not easy to find on every street corner. So determine if one person goes or several people go, what skills are we going to need to find, and then how do we do that? So having a lot of cash in place, either through a key person disability, key person life insurance, will pretty much fix those ills, but it's important also then for your bank lines to make sure you've got plenty of proceeds, make sure you're getting any new partners or new key employees, get them introduced around to your suppliers, to your lenders, so that there's a comfort there if somebody decides to leave or gets killed, disabled, etc. So as a wrap up, No excuses. You got to have a buy-sell agreement. Every one of the business owners, you got to have one. No excuses. Secondly, hopefully we've demonstrated the need for a full team. And no offense intended, gang, it is more than just simply your attorney and your CPA. As important as they are, that's just a starting point. So many business owners try to do it on the cheap and they think, oh, what else do I need? Well, hopefully today you've gotten examples of more things that you need to have, like having someone who's an insurance expert and funding a financial advisor to help, but especially having somebody like Cheryl on the team to come through with what the range of values of that company might be. Now, I might also suggest that you have a conflict resolution specialist or a family psychologist. San Diego is very fortunate. We have some excellent guys, men and women in this space that are really good to help get unstuck situations, get them stuck and get them unstuck. And then myself, I'm a certified exit planning advisor. That's a growing part of the practice world where specialists are really give a whole nother level of training about how to help business owners get through that exit. Cheryl said it, I said it, do a stress test. And you should be doing this every couple of years. What happens? Let's just pretend. Okay, John, you don't show up on Monday. Let's just see what happens to the business. So let's work it through ahead of time. There's the saying, if you don't have a parachute when you need a parachute, never gonna need a parachute again. So let's stress test this before you need it. That's how you get in touch with us. We've got a question that came up. Cheryl, I'm gonna pop this over to you. How do you see franchisees fitting into this conversation? That's a kind of a unique animal. Over the years, I've spoken now for an increasing number of franchise groups at the national level. So how do you see franchisees' needs being any different, or are they basically pretty much the same?
Well, it's, yeah, a sale of a franchise business is different because in a lot of franchise agreements, the franchisor has the right to approve the buyer, or they may even have a right of first refusal to buy the franchise. So it just depends on the franchise and the franchise agreement. So I would just make sure that you understand what's in that agreement if you want to go to sell. And, you know, valuation, you know, valuation is valuation. So the value of that franchise, you know, is really based on, you know, what profits can you generate from the franchise. So that's no different from any other business. There is, of course, usually in a franchise, you know, a upfront franchise fee that needs to be taken into account that has some value because that's your, you know, the baseline to even own the franchise. But generally, just look at the franchise agreement and, you know, see what the provisions are before you start heading down the road.
Absolutely. And what we found as well, particularly if you're an automobile dealer, there is a particular line of that agreement where the franchise, what would be Buick or Lexus or BMW, they have very specific issues that they're going to require. And you know, frankly, we've seen some thriving either dealerships or other types of businesses that were franchises, but because there had not been good communication, or the person who owned the business was getting antsy to get to the sidelines. And so he was wanting to take the first really good offer that came along, and the franchisor really didn't like that new person. So the deal went dead. And so it's very important that those franchisors are kept in the loop right from the start to make sure that the valuations, the other things that they're expecting, and the people that they want to represent their brand are the right people. So if you're a franchisee, you got a whole nother level of planning just to make sure that you get some yeses and get people leaning forward in your direction so that that sale doesn't get hung up on the other side. Great question. Great question.
Yeah.
Any other questions that are, you just go into that chat box, type it up, and we will get to it here. Just about out of time. But again, we're just so delighted that you have been with us today. You may want to, like us, kind of get going. So unless there's anybody else who want to send a question over the chat box, in like the next 30 seconds. I just want to thank you again, Cheryl. Always a pleasure to get to present with you. You are amazing. Not only just in terms of what you know, I've learned so much from you over the years about the stuff that needs to be in agreements that, frankly, I just never even thought of. But not only are you great at that, but you're just a wonderful human being. And
Thank you, RJ. I feel the same.
and thank you one and all for being with us today. Again, I know the folks that are on the call today, I'm honored, we are honored that you would invest your time with us. Please do respond to the survey that's going to be coming out momentarily. Let us know. And if you didn't like it, basically, I want to hear that too. That's the only way we can improve. As Ken Blanchard, a fellow, a mentor of mine and so many of us, Ken Blanchard says, feedback is the breakfast of champions. So give us the feedback, even if you didn't like today. Let us know though how we can improve. Don't just tell it, gosh, I really didn't like that blue and the jacket that RJ was wearing. No, give us some constructive suggestions about how we can make it better for the next time. So with that, on behalf of Cheryl Kessler and myself, CBiz, Wealth Legacy Group, thanks so much. God bless. And you know what? Times are tough right now, but we can lead with purpose and kindness. It's been said that we're all in the same storm, but we're definitely not all in the same boat. And so when you find someone, the fact is that we're all struggling at various levels. As a psychologist friend of mine says, that we're all of us either been in a bike wreck, a car wreck, a train wreck, or a shipwreck. So let's find ways that we can make sure to just give some love and kindness, find out the person next to us, how they're doing. And then also, what can you do to make a difference that nobody will ever find out about? That's what we can do to make the world a better place. So again, God bless. Thanks for being with us. Bye for now.